It's official. As of Monday, we've entered a bear market. We did it, Joe. Seems like only yesterday, well, 3 weeks ago, that the S&P was floating on gossamer, crashing jobs, bankrupt manufacturing, millennials buying ramen on installment for mom's basement. Nothing could dent the coke-addled euphoria of Bidenomics, or Kamalanomics. Since then, it's been rough. The S&P dropped nearly 11% as the parade of economic data overwhelmed the media narrative, culminating in Monday's crash. The question at this point is, are we looking at a 1987-style flash crash, or are we in for a 2008-style reckoning, or even a replay of the 1970s, this time without the Bee Gees? So first, how did we get here? The original sin, in this cycle anyway, was zero interest rates imposed on the crawling economy in the wake of the 2008 bailouts. These crippled productivity, as they have done in Japan, and then COVID hit, nearly doubling federal spending as the deficit hit almost $3 trillion in 2021, Joe Biden's first year. Even when it was obvious COVID was done, the Fed yes-sirred with gusto, dutifully financing permanent trillion-dollar deficits while keeping interest rates high to strangle the private sector. Metaphorically, the Fed bulldozed all the cars off the highway so Joe Biden can drive fast. This sapped the real economy to the point most new jobs were government and what the Wall Street Journal called the welfare industrial complex. But it was all academic until last week when markets finally broke on a series of bad job reports, culminating in Friday's report showing monthly jobs dropping by half. Interestingly, Charles Payne overlaid a chart of the NASDAQ and Kamala Harris's betting market odds. Turns out it was 1-for-1. That is, when cackles goes up, markets go down. The first to break were the high flyers, the tech-heavy Magnificent Seven that have been holding up the entire market. This spread by Monday to the entire market, with pretty much everything collapsing but gold. Japan's implosion over the weekend added fuel to the fire as the Nikkei dropped by a fifth in 2 days, and the U.S. Volatility Index hit the third worst in 35 years. So what's next? Brought to you by Unchained.com. The $64,000 question is whether this past week is another Black Monday like 1987. That was a 23% flash crash that resolved fairly quickly. Or are we looking at a repeat of the 5-year crisis in 2008 or even the decade-long catastrophe of the 1970s? That is a question of the economic fundamentals and what policy is coming next. If, as in 1987, the underlying economy is sound and the president is pro-growth, then even a true crash bounces right off. In 1987, it took 9 months. But if the underlying economy is unhealthy, say if it's made of fake jobs, subsidies, spawned cronies, and $35 trillion in debt, or if we've got Jimmy Carter 2.0 on cackles coming, then we are looking at years of pain. It could be 5 years like 2008. It could be the lost decade of the 1970s, this time with no Paul Volcker riding to the rescue. Read the rest of the article with charts and all the gory details at profsananj.com. Okay, we'll be watching. See you next time.